I am super excited for today. This is going to be an awesome event. This is investing for cash flow. So, just to set the table a little bit, a lot of people are seeing, in general in real estate, it's harder to find new deals with cash flow, right? So that's why we've shifted to go a little bit of alternatives, doing oil and gas and other sorts of private equity deals, debt funds, other things, ATM machines, car washes, all kinds of business things that produce cash flow. So we have Kevin from Fort Lauderdale. So awesome. Welcome, welcome. Keep dropping stuff in the chat there. We got Jeanette. Welcome. It's good to talk to you earlier today as well. Okay, cool. I'm going to go ahead and welcome our panelists up here and give them a quick intro. And I got to say, I am super excited for our panelists today because these guys are like family. Both of them are like family to me. So I'm just going to move them to the webinar. And I think Patrick is in here twice. Hopefully we get the right Patrick. We don't get like some sort of robotic Patrick that's, oh, did we get him? Oh, are you real? You look pretty real. I
We're
don't know.
here.
Awesome. You're here. Awesome. You can you can change your view if you want, everybody. You can go to the speaker view or the gallery view, which I kind of like the gallery view where you can see everybody at the same time. So when one person says something, the other person snickers, you can see it. So anyway, very excited. But I'm gonna give a quick intro and kind of what we're gonna do tonight. So this is gonna be about a 1 hour thing. We'll finish. We'll do some questions toward the end, but we're going to try to get into as much of what's happening today, the questions that you have. If you have questions, you can certainly stick them in the chat. You can put them in the Q&A. We will try to get to them at the end, or you can kind of hold them for the end. But let me introduce my friends here. Again, I wanted to share Patrick. We've been good friends for probably 5 years. I've known Patrick for a long time. We've kind of, walked with each other through the industry a lot. We've been
Mm-hmm.
roommates at conferences. We've hung out socially, been to birthday parties for our kids and all kinds of fun stuff. Courtney, we've spent a lot of time at conferences. We've traveled internationally together with, your family as well. I've gotten to know quite a bit of your family, which is great. And yeah, so anyway, just really, really love each of you guys. Patrick Grimes is the CEO of Invest on Main Street, or now it's Passive Investing Mastery. So he's expanding and having multiple companies now that he's doing. And obviously he lives a lifestyle by the water, so he can enjoy that view all the time. So welcome, Patrick. Really excited to have you and see what you're going to contribute today. So really excited
Excited,
for that.
Bronson.
Awesome. And Courtney, really excited to have you as well. I got introduced to you. I think you were introduced as like the blockchain specialist or the blockchain babe. And so I know you do all kinds of your stuff, crypto, you have oil and gas as your background. You've been a part of drilling over 60 wells, and you live in the great state of Texas, which does a lot of things great. So excited to have you here as well. So we're going to go ahead and jump in here. Welcome, welcome. So let's just maybe give a quick introduction. I gave you an introduction, but why don't you guys each introduce yourself and just talk about kind of, what you're seeing right now in the market and why, this topic of cash flow is a topic that it's top of mind for people. Let's start with Courtney and then we'll work over to Patrick.
Yeah, well, first of all, thanks for having me. I always love hopping on here with you and Patrick. You guys are amazing, and I love watching what you're doing because it's always so unique, and I love that. It's always unique and different from everything else that you see everybody doing. So, my name is Courtney Moeller. I am from West Texas. I live in the Dallas-Fort Worth area, and I grew up riding pump jacks on Fridays. My dad drilled oil, my brother, my uncles, my sister, we're all involved in oil and gas. But it's funny because several years ago, when I got involved in investing, I was trying to figure out how to diversify. So, all of our income was dependent upon the price of a barrel of oil, which is great at $100, and it's really not so great when it's 30. And so that's actually how I ended up meeting you, Bronson. It led me into investing and figuring things out and down all these paths. And that's really where I learned about syndication. And my mind was blown when I figured out that people were pooling money together to buy assets. And I thought, God, I'm a pretty smart girl. How did I not figure this out like, 20 years ago? And so now it's just been this path and journey of trying to figure out, it started off really kind of small-minded where I was trying to figure it out for myself and my family. And then it was like, man, I can help my friends. And then it's like, let's help the world. And it's really all about impact. And so I think a lot of the conversations that I've had here recently is, some of the real estate, some of the multifamilies not cash flowing very well right now. So people are looking for investments to get into, that are cash flowing. And not just that, but I've had a lot of conversations recently where people are really concerned about all of their retirement being in the stock market. And they're like, okay, I'm really scared that this is going to crash and burn over this next couple of years. I really need to get into some other assets. So that I can diversify my portfolio. So it's kind of the conversations have been all over the place. And, we're seeing some new asset classes emerge. And, I know you guys are doing really cool stuff with income funds and debt funds. And, I've been investigating marinas and just some other really cool asset classes that are really kind of at that beginning wave where multifamily and things were 30 years ago before everything was very institutionalized the way that it is now. So I'm always out looking for, people
cool
can
new
get
things
involved
that
in
people
that
can get
provide really
involved in
good
that
cash
provide
flow.
really good cash
Yeah.
flow.
That's great. No, I love it. I
That's
love
great.
the creativity.
I love
and
the creativity
background. I
and
don't know
the
what a pump jack
background.
is.
I don't know what a pump jack is, but I imagine it has something to do with drilling.
Right.
So
Riding pump jacks.
riding pump jacks. So it's like a jackhammer, but for
like a jackhammer,
No,
but
but
for
you know what? I have a
Picture right there.
That's
Right
it.
there.
That's
There
it.
you go.
Is
There you
that
go.
is
And
actually
so
a pump jack in West
from a
Texas
pump
where I'm
jack in West
from.
Texas
So
where I'm
okay, we just call those
so-
rigs.
Okay, we just call those rigs. I guess you
Well,
call it a pump
the
jack.
rig is
then.
the actual
It's a bigger-
rig is the
yeah, it's a
actual
bigger-
the big
yeah,
rig
yeah.
power that
The
does
dig,
the
yeah.
power that does
once
the-
those
wells are drilled,
once those wells are drilled,
some
you slap
need
a pump jack
some
because they
need
help
a pump
extract
jack
the
because they
oil
help
from the
extract
ground.
the
Some
oil from the
just
ground.
flow
Some
naturally and they
just
don't
flow
need a pump
naturally
jack.
and
So
they
it
don't
just
need a
depends
pump
on the
jack.
well.
So it just depends
So when you
on
ride
the
a pump
well.
jack, you're
So when
sitting
you
on
ride a
there
pump
and
jack,
kinda
you're
like
sitting
it's
on
like a
there and kinda
merry-go-round,
like
but
it's
you're
like a
sitting on there,
merry-go-round,
just
but
don't,
you're sitting on there, just don't,
Yes.
fuck
Yep.
Try not to get
Yes.
too oily.
Yep.
Try not to get
Okay,
too
I love
oily.
it. I love it.
Okay,
Yeah,
I love
that's
it. I
great.
love
Well,
it.
awesome.
Or too
That's
gassy,
great.
I
Well,
guess.
awesome.
Or too gassy, I guess. It's natural gassing.
I guess so. I guess so.
I guess so.
Thanks,
I
Courtney.
guess
Really
so.
great to have
Thanks,
you here.
Courtney. Really great to have you
Patrick,
here.
give us a
Patrick, give us a
background on what you're seeing right now and what you're seeing with investors
you're
and
seeing with investors
people
and
are noticing
people
and why people
are
are
noticing
interested in
and
this
why
topic.
people are interested in this topic.
Well, I'm glad to be here. First of all, Bronson, great friend, Courtney, same. And I'm kicking off a vacation in Hawaii at 7 a.m. this morning. So this is the very last thing that I'm doing before disassembling the workstation and then migrating to the island for a few months.
Yeah,
So-
I think I talked him into putting me in a suitcase while we were backstage a minute ago.
So excited about it. There's a lot to talk about right now. So Invest on Main Street, the company Bronson talked about, was the company that I created to help do multifamily apartment investing, which I'm a high-tech professional by trade. I master's in engineering, MBA, bachelor's in mechanical engineering. And I did a lot of work and with a lot of very smart people, except for all of them were just putting everything in the stock market, day trading, doing Bitcoin. Nobody knew how to invest like the wealthy, the higher income. And even though they were higher income, they didn't know what to do. I got some advice early on to get into real estate. So I went down that path, made some bobs and turns, and I'll offer a free copy of my book at the end of this if for anybody who wants to hear my whole story. But I was able to break free of the high-tech world. I did very well in it, but I was able to get a different level of diversification, income, and be able to leave that world, just like Bronson. I actually don't know if Courtney still has something else going on, but I know Bronson and I have both moved on and from our past lives, and now we get to participate in connecting with investors, connecting with partners, and putting together investments. And so about 5,000 units in Invest on Main Street, multifamily, but in Passive Investing Mastery, we're a little bit broader focused, where we have education on mastery events where we educate on all kinds of different investments. We have an acquisitions fund, buying things in cash. We have debt funds, income funds, providing cash flow, which we'll talk about today. And we have alternative investments like litigation funding, things that are non-correlated to broader markets. And we have dabbled in oil and gas, like Courtney as well. So, and actually went a significant chunk in that direction as well. So looking to help provide mastery in the art of passive investing into alternative investments. And I'm excited about it. And there's a lot to talk about, as what Bronson said, in terms of where people are at, where the markets are at, and are we in a recession? Are we heading to recession? Why would people want to buy for cash flow? I'm looking forward to digging into all that right now.
Yeah, lots to dig into. And so for those that I haven't met, my name is Bronson Hill. I'm CEO of Bronson Equity. We've got about 200 million in multifamily. We've shifted the last couple of years to do a lot of these cash flowing type of investments, oil and gas, ATMs, car washes. We're doing a lot in the private equity space. I can share about in a little bit. But really excited to put this event together. The purpose of this event really is education and just really creating value for you around, things that are real. Because again, what I realized in writing my book, Fire Yourself, was that You can't, making a lot of money someday is not helpful if you're trying to leave a job, if you're trying to cover a mortgage, if you're trying to cover your expenses. And so that's where cash flow, I think, really is king. If you have a net worth of $10 million, maybe it doesn't matter. Maybe cash flow isn't as important. But if you're most people are trying to live and trying to figure out how to cover. I just had a call today with a guy who's making, his family making $400K a year. And he's like, can I leave my job in 3 or 4 years? And I was like, well, it depends how much you spend. It depends how you invest, but it's possible, right? And so how do you start building that? It's through cash flow investments. So we're going to talk about that, and we're going to have a discussion about it. But let's talk for a little bit about just kind of that process, because I think I know for Patrick and I especially, I don't know how it is for you, Courtney, as well. But I think I know I've had a revelation of like I said, cash flow is better than making a lot of money someday. And we do long-term deals, we do VC, we do long-term back-end things as well. But to really evaluate a cash flowing opportunity, how do you evaluate that? Do you look and say, well, is there like a ratio? Like if I make a bunch of money in the future, maybe twice as much, it's better to have the cash now because then I can use it in my business or I can use it for living. Courtney, how do you evaluate that when it comes to the deals you're doing? And I want you to maybe talk about, some oil and gas and talk about some of the other unique projects you're doing at marinas. Like I'd love to hear more about that as well, and just kind of how you evaluate.
Yeah, well, it's funny because I've really shifted and changed things quite a bit over this last few years. I used to go in with I'm looking for this net worth, or I'm trying to accumulate these things, but really at the end of the day, it's cash flow. I'm looking for a certain amount of cash flow each month, and so really I evaluate things based on, is this investment opportunity going to get me to where I'm trying to get to? So I finally had to stop and go, okay, what is the end goal? What does that look like? That way I could kind of figure out what the path to get there is. Because when I first started, I feel like I was very much doing the just, spraying and praying and hoping stuff sticks. And I didn't really have a plan. And I just thought, oh, that's a cool asset. I want to get into that. And so I had to really kind of take a step back and be like, okay, this was really great, but I need some great, cash flowing assets. I need some midterm plays. I need some long-term plays. And I think it's really important to be diversified in all of them. Some of the real estate that I have is not cash flowing all that well, but I know here several years from now, there's going to be a little more upside on the back end, which is great. The oil and gas I love because I can depend on that for monthly cash flow. And there's not a lot of things out there that give you monthly cash flow and monthly strong cash flow. I know some of the debt and income funds do. There's some other great things out there. So now I'm looking at, okay, what are we seeing in the economy? What's inflation doing? The other thing I love about oil is that it actually tends to perform really well when you have times of inflation, because those commodities tend to follow that price, which is really, really great. So it's a great way to kind of hedge and protect yourself. And my personal strategy is to take some of the income from that and funnel it into real estate and some of these other projects. And so yeah, that's kind of what I'm doing. So it's really now I've been looking at, okay, what do I want to make sure I'm leaving my kids with? I want to make sure I'm making this much money per month, and I want to make sure I'm leaving this kind of a legacy with my kids. And then I'm really spending some time educating my kids on it too. So, when I inherited a bunch of money from my father, I totally blew it. And it was like, man, that was really stupid. I should have invested it, lived off the cash flow from those investments instead of spending the money. And now I'm making sure that my kids understand what that looks like and how to do that so that they don't go down and make the same mistakes that I did, 15 years ago.
Yeah, I think that's really good. I think we all have lessons we wish we'd learned a long time ago. We meet people like the Donis brothers who are like 22 years old and they're like raising millions of dollars and doing big deals. But, we get it when we get it and we learn it when we learn it. But I think the idea of what you said of developing cash flow, living off your cash flow, and then using it over time to buy assets, and to buy things that hold value or appreciate, which is great. And it's not that, non-cash flowing things are all bad. I mean, I buy a lot of precious metals and gold and silver and things like that for other reasons to hedge inflation, and they don't produce cash, but I'm sure glad I have them, right? So the things are out there that are good as well. Patrick, why don't you touch base on how you evaluate cash flowing deals and kind of that transition for you as you've kind of started to focus a little more on that?
Yeah, well, the typical investor progression that I went and I see a lot of my investors go down is you put everything into a 401k and you just sock it all away for a future day that your employee sponsored 401k. Then when you get a surplus, then you're into an IRA, and which still is not going to produce cash flow until you're 59 and a half. Then you meet a financial planner who's only going to further put you into four market sentiment driven or additional market sentiment driven stock portfolios and index funds. And still, there's really no cash flow. And it takes that extra leap of somebody moving into an alt space, alternative assets outside of those stock markets, to all of a sudden realize, well, you can have cash flow and appreciation. You can actually invest for cash flow today. You don't have to work until you die or work until you're too old to enjoy it. And so that's what's really tough. And then typically what'll happen, people will get into a single family home or something like that. And then they'll realize it's such a lot of work. That's what I did. I was just struggling. I was getting some cash, but not a lot. Certainly wasn't as much cash flow for the work I was putting in that I made at my job, at my machine design robotics, right? So the diminishing return was there. And the typical progression from there is then they learn about syndications. They can get into passively, right? And then they can invest for cash flow. They can invest for appreciation. Then they can diversify across assets. They can diversify across geographic locations, sponsors, and it requires some ability to partner. And that's sometimes the challenge. I think at that point, people are like, well, now that I'm thinking more of like a portfolio, people think diversification, right? And then they're thinking cash flow appreciation and now recession resilience. And that's where we kind of meet ourselves today when, although nobody can ever predict a recession, are we in a high probable sense likely to hit one right now? Well, the last 11 of the last 14 rate hikes ended in a recession. And it's not often when real estate's down at the same time as the stock market. It was the case in 2009 and 10. And right now, not only are we at a point when we just had a massive rate hike, probabilistically in a recession, but we have some of the largest economies in the world betting against the dollar. And so it's going to be tough to see what happens. But I think at the end of the day, you need to look at both cash flow and yield, cash flow and appreciation. You need to look at non-correlation. You need to look at diversification into recession resilient assets. And I think the go-to in sort of that cash flow play, people start to get fearful. They want to start investing for cash flow. It's more important to start investing for cash flow where those investments don't rely on the same market fundamentals. And if you're all in real estate and it's all cash flowing different kinds of real estate, you're still affected by interest rates. You're still affected by legislation, COVID, the need for housing, right? All those. But things like oil and gas, Bronson's ATM fund, litigation funds, those are things that don't necessarily correlate together. And you can then build through that cash flow plays, which won't all be down at the same time. I think that's where you get to eventually as a sophisticated investor, building out your cash flow allocation.
So you talked about the word allocation, and when I was a RIA, which is a registered investment advisor, I'm no longer a registered investment advisor. I'm still an RIA, which is a recovering investment advisor, right? Wall Street doesn't treat people well. I talk about the.
I still hold that against you, Bronson.
I know. It's seriously. But this is really the question of how do I, and we get some questions in the in the chatters. How do I allocate? What do I do? Do I do cash flow? Do I do appreciation? And I think of a call I had today, and they're not on this call. If they were, I could still mention it. But this person had something like 15 units. They were an engineer. They had something like 15 units that were fully paid off somewhere in the Northeast in metro areas. So, I mean, I estimated, probably $4 or $5 million just in the real estate. But they were getting like super low cash flow, right? Because you have paid off buildings, there's no leverage. We didn't quite calculate, but I was imagining probably 2% cash flow, 2-3%. And that's where the number really comes of whatever you have in your investments, what kind of return are you getting from it, right? What kind of actual money in your pocket? And this is where I look at, the total return is nice. You get a lot of total return someday, but that doesn't help you live today. That's not what helps you live today. And I think you do need a mix of both because there's a mix of kind of long-term wealth building. But if you really want to become free from a job, if you really want to be someone who can live a certain lifestyle, if you grow that passive revenue stream each month, each quarter, it changes the way you live. You actually can live a different life. How do you, I guess let's kind of go into that for a little bit. Let's talk about allocation. How do you allocate between appreciation assets and cash flow? Would you say like do you need 50-50? Do you need 50% in strong cash flowing things that maybe don't have appreciation? Or is it, obviously some have a mix, like multifamily, hopefully, well, these days it doesn't have much cash flow, but it used to have cash flow and appreciation. But is it good to have kind of like a 50-50 mix? Is it more to kind of be more back end and do a little cash flow? Courtney, what do you think about that? I mean, in general, we're not giving any advice, but for you, how do you look at kind of how you diversify your portfolio among those two things?
Yeah, well, it's funny. I had a conversation with a financial advisor the other day because her recommendation was everybody should have at least, I think it was like 65 or 70% of their money in stocks. And I said, well, I have zero in stocks. We have nothing in the stock market. And so
Right.
she was like, none. And I said, nope, none. Everything that we own is precious metals, real estate, oil and gas. We've got Bitcoin. I'm invested in a couple of different tech deals. And so I diversify it that way. And really right now, as we are heading into what I would consider an energy crisis, I'm really heavily focused on moving into oil and gas. And I will tell you that the demand for oil, we are not exploring and drilling what we need to keep up
Wow.
with that. And we're not feeling the weight of that just yet, but we will eventually. So for me personally, right now, I'm trying to move very heavily into that space. And it shifts. A few years ago, I was moving heavily into real estate. Now I am moving heavily into oil and gas. And I will sit back, and as we see some really great distressed assets coming on the market in the commercial real estate space, I'll start deploying some of the funds from oil and gas back into real estate. So and I think it's important to be, diversified into different asset classes in real estate too. So yeah, but I like the marinas is really interesting. I haven't raised for
Yeah.
that yet, but I'm really interested in it because it's kind of where we were with like self-storage and RV parks and things, 10, 20 years ago. They're owned by mom and pops. They're doing their accounting on the back of a napkin. And so they don't even know what actual rents should be for their boat slips. There's a lot of value add opportunity. You can go in and acquire them, seller financing, or even, take over their very low interest rates. But then there's a way that, they cash flow 10, 12 different ways because they've got restaurants and gas and boat ramp fees and all of these other things. And so there's a lot of opportunity. So it's not something I've 100% moved into, but I'm very interested in it because I think there's a lot of opportunity.
Yeah, absolutely. I think that's great. And I love the diversification of different streams that you're doing. That's awesome. Patrick, what do you think? What's a ideal allocation for you between appreciation and cash flow? Do you have a percentage for each one that you focus on, or that I can nail you down with?
Well, I'm sure you tell your clients that you should keep it all when you were back in a investment advisor. You should keep it all in market driven stuff that cash flows if it does. And the challenge is that it really has to do with where you're at in life, I think. And so right now we have an acquisitions fund for high appreciation. We have an income fund for fixed income, no appreciation. And that's because some people in their particular place in life are looking to either want to cash flow or be ready to cash flow at any time. They're getting close to that. They're 45, 40, 50. They're thinking a little less risk, want to be lower on the capital stack, meaning secured debt instead of volatile equity. And then they just want to flip the switch. If you look at it, and so other people are like, man, I don't want to cash flow. I want to be able to grow, right? And then flip the switch to cash flow. But if you look at kind of the Tiger 21, which are those individuals which have over now 20, I think it went from 10 to 20 million in assets just the last couple of years. They publish their allocations. And so you're talking the ultra wealthy has 7% in fixed income. And that's it, right? The rest, 27% in real estate. That's actually 27% real estate. Where else are they investing? And I think that's those asset classes of 26% in private equity and hopefully alternative investments. Now, on the private equity side, you're typically working in hedge funds, or you're working in deals like what are being suggested here, legal finance like we're working on, some of the income stuff. Courtney's maybe doing oil and gas and I had Bronson's ATM funds. So you're really at 7% real estate, can have a combination of cash flow and appreciation depending upon what you're doing, right?
Mm-hmm.
And then the 26% in private equities can be alternatives, right, to the traditional allocation. Those can all have a combination, and really has to do with where you're at in life, what level of risk you're at, and which your needs are from your investment portfolio. I tend to steer people. I mean, people tend to. We can't give advice. I'm not an attorney. I'm not a CPA, and I'm not a financial planner like Bronson was. So I don't give legal, financial, or tax advice. But I do talk about my particular allocations and both precious metals and how I have cash equivalents, not necessarily cash, and you have 9 to 12 months worth in cash in the bank. Then you have allocations into non-correlated investments. I don't like to use the word diversification because people think that different kinds of real estate is diversification, and it's not, right? That's like saying your financial planner or your custodian has you diversified in your 401k account into real estate because they have a REIT. Well, the REITs fall. They track, they're sentiment driven. They track directly with the S&P 500, right? And they don't have any of the inflation hedging, depreciation, tax advantages of it. So you really got to look at that allocation and non-correlated investments, and then play that part of where you're at in your life. I tend to right now be in more of a growth mode. I mean, we do have an income fund, but my investments in my own income fund compound monthly. I just reinvest them every month. I know that at one point I can just flip the switch and then distribute. And that's a little bit of an insurance policy myself if I wanted to immediately start cash flowing.
Yeah, that's awesome. No, I think that's great to look at, different options and really figure out what works for you. Courtney, I want you to talk a bit. I know you have a lot of background. I believe you are an oil engineer, right? That's your background. And you grew up with it, obviously writing pump jacks, which I know what that actually means, but talk to us a little bit about, for somebody that's not really familiar with it, the different types of oil and gas deals. We've done, I've done some drilling deals that are more kind of wildcat going, looking at new sites. There's some incredible tax benefits there. Done non-operated working interest where we own the land. Can you talk about maybe the benefits of oil and gas and some of the different types of deal structures that are out there?
Yeah, well, I will start that with I am not a petroleum engineer. My dad was a petroleum engineer.
Not close enough. You were there, right?
I mean, I stayed at a Holiday Inn, that counts.
It's in her blood.
I love it.
Yeah.
Yes. And so there are different interests. There's different types of royalties. And so I offer what's called a non-operating working interest. We go in and acquire interests where the majors are performing. And actually, we go in and acquire interests specifically into the wells themselves. We're not going in and acquiring an interest in 5,000 acres or anything like that. We specifically do that. But you can, if you own the mineral rights in certain areas, if anybody happens to drill there, you'll just start getting royalty checks every month, which is fantastic. There's not any really tax benefits to that, but you can 1031 into mineral interests, which is a good deal. I don't offer that myself, but it is something that you can do. Now, working interest is generally what a lot of people are interested in because of the tax benefits, because back, gosh, in like the 70s, the IRS incentivized people to explore and drill through tax incentives because they needed it to happen. But it's one of the only asset classes I know that can directly offset, W-2 income, passive income, capital gains, pretty much anything out there. The only caveat to that, and I kind of feel like this is another way that, W-2 workers get punished, is you can only offset up to $250,000 of W-2 income, but there is no cap on capital gains. I mean, you can offset $10 million in a year if you need to. And so a lot of my, doctors and, high income people are trying to figure out, how to, strip down that check to the IRS and create, additional cash flow. And oil and gas is really a great way to do that. The trick is getting involved with the right kinds of companies. Like you talked about wildcatting. Okay, wildcatters are out there just randomly drilling holes somewhere in hopes that they're going to hit oil. And I don't want to be a part of that. I am interested in proven areas with proven reserves, proven reduction with, billion dollar and multi-billion dollar companies. I just feel like that's the least riskiest way to get involved if you're going to get involved in with a working interest, because the working interest is what you need if you're going to offset your income.
Yeah, absolutely. No, it's amazing. I think for a lot of investors, myself included, if something's
different or nobody's done it, whether it's, if somebody first getting involved in a syndicated deal or it's like oil and gas. So that just sounds kind of crazy. And it's like, well, I think it depends. It depends who you're working with. It depends, obviously having a reference, having some sort of track record, what type of thing is it? How much risk actually is there in it? And, we all learn along the way. So I think it's really valuable. Patrick, I want you to talk a little bit. You can add to that as well about energy, but because I know you've done some as well, but I want you to talk a little bit about your, distressed asset fund, some of the stuff you're doing there, some of the other stuff you're doing with your debt fund. Just maybe you could talk about some of the reasons you've kind of ventured into those assets and how it benefits investors.
Sure. Well, so right now, as probably a lot of people are aware, because the most popular alternative investment, which is an alternative, is real estate outside of the stock markets. That's the gateway drug to alt assets. And it's not the end of the journey. It's not the journey, it's the beginning. And it's the gateway to the journey. And so what has happened though is that even the Tiger 21, 27% allocation in real estate, that's taking a hit right now. And there's an inverse correlation that has been shown with interest rates and real estate valuation. And so since we've seen the rate hike, we've seen both and the aggregate across the markets in the United States, residential and commercial valuations decrease. Cost of capital is more, it's harder to lend. They get less for the properties on the lending, so they're not going to pay as much equity, so the price goes down, right? And so it's pretty simple. That's also at a time when those rising interest rates put the banks at distress, right? Because most banks have large bond allocations, and so the bonds that they had bought previously are now devalued because they're lower interest rate bonds. So they started taking losses. At the same time that these apartment buildings they're not coming to fruition. There's regional banks that lend on these real estate assets. They're not meeting their requirements. They're not meeting their loan to value requirements, and they're not able to perform. Some of them are upside down 10, 20, 30%. So they're hitting liquidity crunches. So really when you see crisis, you see opportunity. In 2009 and 10, I had personally guaranteed a pre-development, and I was head over my heels in debt and losing everything, and watched and waved goodbye the best buying opportunity in residential real estate in 2011 and 12, as I was the recovering engineer, trying to moonlight real estate, and I've since humbled. This time, I am excited that we can be very well positioned to take advantage of what is actually the best buying opportunity in commercial real estate. Even better, prices are more depressed now than they were in 2009 and 10. So right now is the best time to acquire commercial real estate in my lifetime. And it just so happens to be that debt, which used to be 6, 7, 8%. Now those same loans with banks pulling back and unable to lend, or just constantly jerking borrowers around with all this opportunity to buy, they keep reducing loan proceeds, and they just aren't coming to the table. We can lend on performing assets. Instead of 6, 7, 8%, we can lend 13, 14, 15%. And so the lending opportunity is just incredible. And you can really win from the downturn right now in commercial real estate. You can do that by solving people's problems. You can find operators that really need or want out. And if they really need or want out, we can jump in and buy that in cash, which we're doing. And you can make a great return just by buying right. Sounds a lot like 9 and 10, right? That's what it was like. People that became billionaires bought, and you could just make your return on the buy. And if they don't want out, if they want to give it a shot, but man, they ran out of their debt's running out right now because they got a short-term bridge loan, and they got $1.5 trillion of commercial real estate debt coming due through 2025. 64 billion of it is distressed, right? These crazy numbers. They just need more time. COVID set them behind. Their material costs went up. Their labor went up. Their insurance went up. The interest rates went up. All that ate into their operating reserves. They need more time. They need some more money. They need or want to hang on to it. Well, we can lend to them. We can lend to them maybe at a higher interest rate, but we can give them more time. And that's what the bridge loans are that we lend to in the loan portfolio and the income fund. So taking opportunity to buy is really serving the need out there. It's buying in cash, people that want out, and lending on people that want more time.
Yeah, that's great. No, I think it's good to see what's out there, and of course, we've put the brakes on a lot of our general, the multifamily real estate stuff. But, if there's distressed stuff and people have to sell, it's great to be able to take advantage of that. I think it's the idea of playing offense and defense at the same time, right? Defending what you have and being open to new stuff as well. We're going to jump into some questions here in a minute. I had a couple more questions for you guys, or at least one more question we'll go through, and then we'll start taking questions because we're getting some really good questions come in here. But I was going to ask and see, a lot of people are kind of new. And what do you suggest to somebody who's, no specific advice, but just starting out, kind of, okay, I know I should be doing some of this. I know I've got a sizable net worth. I know I'm paying a lot in taxes. I know I want to start developing some cash flow. Maybe I've invested in one deal or haven't invested at all. What are some recommendations? Maybe start with you, Courtney.
That is such a great question because I went down this path several years ago and, I had shiny object syndrome and I wanted all the things. And I have to step back and be like, all right, okay, let's take a look at that. And so I think this is where that, when you're getting involved, it's really important to find knowledgeable people that know what they're doing. They've got great track records and they're passing out really good information. I've met incredible people like you guys, just going to investment conferences and podcasts and YouTube are your friends. Every time I go, I come out with amazing takeaways. I've learned new information. I get involved in really incredible conversations about strategies and the way people are approaching things. And it just gets me to thinking about, okay, what does that look like? How does this affect what I'm doing? And essentially, like I said, I've gotten to the point to where now I know what my end goal is. I know what that looks like. I know where I'm trying to get. So now everything that happens to fall into my lap, I ask myself, does this thing get me to where I'm trying to go? And if the answer is no, I move it off my plate. And so I think really you gotta kind of figure out where you're headed, where are you trying to go? And that way you can start taking a look. But gosh, there's so many great, people. I know you guys have podcasts, investment things like this. And I love hopping on phone calls with my investors and with people and just figuring out, what do they need? What problems are they trying to solve? And if I can't help them, who can I send them to help them figure it out? And so there's so many great asset classes. There's so many great people doing great things. So, gosh, like I said, YouTube and AirPod or Apple podcast, YouTube and conferences are where I learn everything. And there's just something magical that happens when you get in the room with amazing people. So.
And this is a topic we talk about a lot on the Mailbox Money Show. We've had Courtney as a guest, had Patrick, I think a couple times as a guest. And so we talk about that. How do you, as a passive investor, you can be stuck on one asset or you can try to figure out what fits your parameters. And for one season, it may be one thing, another thing, maybe another thing, but it's usually three reasons, either cash flow, appreciation, or tax benefits. Those are really the three things. Or sometimes deals have all three. But a retirement account is going to be different. Maybe your needs are different than just what you invest in personally. So I think there's a lot of things. It's just important to evaluate what you really need and how that changes.
Yeah. And I had to really kind of manage my expectations too, because I hit the ground running several years ago and I thought, oh, I'm going to make these investments and I'm going to make $100,000 a month and I'm going to go do this and that. And it was like, okay, hang on. I had to kind of reel myself in and be like, okay, what does this look like? And now I'm really focused on, what that end goal looks like so that I can make sure that I am putting my money and spending time into, in these investments and the types of things I need that are going to get me there. So, because there's a lot of great stuff out there.
Yeah, for sure. And actually a question came, I just want to answer this question, what deals have all three: cash flow, appreciation, the trifecta, right? Which have all three. I mean, ideally, multifamily has all three. Right now it's hard to find cash flow, but there are some deals that do offer all three. They offer, equity appreciation, there's tax benefits, sometimes, equipment or things like ATMs or other, equipment type technology stuff sometimes can have all three, but I don't know if you guys have input to that. What offers all three?
My take on that is, sometimes when you buy the Swiss Army knife, it's not a really good knife for any particular job, right? It doesn't quite fit every. And if you look at the allocation of the wealthy there, it's not one ring that's the one pie chart that's just one color that says all three. It's
They
different.
have different things.
It's
that do
different
different.
allocations
Yeah,
for
yeah,
different reasons that have
yeah.
different terms that have different indexes. And so I don't think the goal, in my opinion, is chasing all three. I think if you chased all three, then you would be over indexed in one particular asset class that's correlated on certain market fundamentals. My take is allocate, but then be very careful to make sure they're not correlated to each other. I mean, for example, did you know that oil and gas and gold are correlated over 80% of the time in history? So if you're in oil and gas and you're in gold, you're not diversified between those two, right? But if you're in gold, then and you've got a bunch of cash on the sidelines, and if you took maybe your 100 grand, maybe did 50 grand in gold, 50 grand in cash, turns out that cash has been inversely proportional to gold. So it's a good hedge, right? Now you're uncorrelated.
Yeah, exactly. Go ahead.
Yeah, allocating into like one of Courtney's deals or oil and gas deals, like with Bronson and I've done before, can give you that ordinary income write-off. However, you're a little more subject to the risk profile and volatility of the commodity. So those returns can be a little less predictable. If you're looking for cash flow, but without so much of the tax advantages, you can be in oil and gas and be in mineral rights. And in fact, my great grandfather was in oil, and we're still collecting checks from that. So those can provide generational cash flow, and those can be very solid, not tax advantaged. It's not the point of it, right? So point of it that you've got allocations that will rise and fall on different market fundamentals. That's why I think legal services, as well as, which is an investment we're launching, as well as medical investments, as well as investments in the education field that have completely different market fundamentals that are not correlated to broader, more traditional alternative investments, right? So those are kind of the more uncommon ones that are more important to allocate to. They're not going to have all three, but the net result of your portfolio will not only have all three, but will have more stability and resilience. So when you make the money, you can keep it, right?
Yeah,
and that's the real point of wealth building.
And that's really the point, right? Is figuring out what the goal is. I mean, for example, I'll share this briefly. You know, I share this a lot, and these guys are not on here, but some people know some of these guys, but I won't identify who they are. But a couple, relatives that had a medical practice in California sold it, and had a multi-million-dollar, tax bill on the sale of the business. But because they were able to structure correctly, their wives became real estate professionals. They were able to invest a lot in assets that offered a lot of depreciation. They were able to use that against ordinary income. They were able to pay, it was $125K, which should have been over $2 million, right? So they were able to find a way, but they were trying to solve a specific problem, right? So again, a lot of investments work really well. They did it through a variety of investments that offered a lot of depreciation. So one thing I'll say real quick, we're going to get into questions, but I want to say, reach out to Patrick, reach out to Courtney, get on their deal list. They have some amazing deals. I respect them. I like them a lot. So reach out to them. We have our deals as well. If you're not on our list, get on our list, get on other people's lists. And I like people that are doing things alternative real estate, because you'll hear about deals you really sometimes cannot hear about anywhere else. Like as a retail investor, you just cannot get access to them because of the size of the deal, because of who they are, whatever it is, for various reasons. So let's get into a couple questions here, and then we'll kind of go over next steps here as well. So we've got a bunch of questions. I'm going to kind of track and kind of go through some of these. Question here, breaking into oil and gas. There's a question of, what if I don't meet the minimum for oil and gas? Is there any ways to get in for maybe non-accredited or investors that are smaller? I've heard of a couple deals that are for non-accredited investors in oil and gas. It's very rare. Have you guys heard of deals for non-accrediteds or other ways to get into oil and gas and still get some of these benefits without being accredited or without putting a lot of money in?
I have not heard of any that are not, because since, oil and gas is considered a riskier asset class, that's usually a requirement. I will say we will take a lower amount. However, you do have to be accredited. But I will keep my eyes peeled. I'm always looking at what's out there and who's offering what. And so I will, Bronson, I will reach out to you if I ever happen to across anything that is not
please.
have an accreditation requirement. And It's tough. It's tough that is. I don't think the government should be able to dictate what you do with your money, but it is what it is.
It's a little bit of a catch-22
Yeah.
because if we were up here talking about our investments, then we would be limited to working only with accredited investors. And those that work with non-accredited investors can't openly talk about their
Can't talk
investments.
about
So
it.
they wouldn't be here talking about
It'd be like
So-
Fight Club. We do not talk about oil.
Right.
fracking, you know?
By just the fact that you're asking us this question, we
Yeah,
have to
I
say
know.
no because
Like
by
I'm
def-
leaving right now because you're asking me that. Yeah, no, you're right. It is kind of one of the laws of 506B. You can't really openly talk about a deal that's for
Mhm.
not accredited. So that's why. And actually,
Well,
somebody's asking, what's your best deal right now? I would say reach out to these guys because again, sometimes there are deals that we can't offer publicly, but we can share, individually. And so that's it's a challenge of this. And that's an advantage Wall Street has is they can talk publicly about everything, and it's education, and there's billions of dollars that go towards it. We're limited. And so that's why we do private things like this, but we've still got to have a relationship with individuals in certain situations. Okay, cool. There's some specific questions about specific deals. I would say somebody about asking about Courtney's minimum for your oil and gas deal. I'd say just reach out to Courtney, get on her list first. Okay, a couple questions here about I've heard cash flow pays for bills and equity bumps make you wealthy. I guess we kind of talked about this a little bit. I'm going to go ahead and say we talked about that. How has fundraising been for 2023 and 2024? The Fed's announced little to no rate cuts this year. Investors are they still shy in your opinion? How has the investing landscape changed? Who would like to answer this? Who would like to go?
Well, I get because I got a great story on that. Well, we went from raising boatloads of money for great deals in multifamily to a dry spell when we had to kind of reset, retool, and pivot to in a more opportunistic time frame in which we set up two blind pool open funds, one opportunistic acquisitions called the Recessionary Acquisitions Fund, and then one's called the Recessionary Income Fund, Recessionary Debt Placement. And then all of a sudden we started raising incredible amounts of capital because really the reality is just like I was waving in 2009 and 10 goodbye the best buying opportunity of our life, I think a lot of investors have been waiting for that chance to dive in, and they want to participate in the upside of a downturn in a cycle. And that's what you can do right now. And provided that you're not just structuring things the way you used to do it, which they don't pencil, deals do not pencil the way they used to. And I'm an engineer analyst, and I'm the first one to say the old play crystal ball is broken, right? But now we can retool, we can repivot, and we can make incredible deals. We can buy in cash, we can lend immediately, we can own and produce returns we used to take 4 or 5 years. Investors have really resonated with that. Simultaneously, people are kind of burnt on real estate. Either they had an over allocation, but they were kind of allowing it because we were on an upwards trend, and now it's reduced. And now they're saying, hey, look, I'm still not stoked about the stock market, or I'm worried we might be headed for a recession. It's likely that might be the case. It has been before after rate hikes. Real estate still, I want to allocate somewhere else, right? And so lowering the capital stack and debt has been a play, and alternative investments like oil and gas or our litigation fund are very attractive because they're not correlated to any of those broader markets. They have a viable alternative investment to stabilize your long-term wealth building strategy. So we've actually had, although it's had some interesting conversations and there's been some unfortunate stories we've heard, like people have lost $20 million, but the reality is that we're seeing very strong interest in our investments.
Yeah, that's great. Well, I think there's some questions coming out too, like what's your favorite investment right now? And we have a debt fund we're really excited about. We've got a couple other things we're working on we're really excited about. One thing I'm really excited about that we're kind of in early stages on is really, the idea of buy then build, right? The entrepreneur through acquisition, right? Finding businesses and being able to scale them up. And I have a couple partners in the e-commerce space. Here's just an example. I can't share. Well, I'll share this example. It's a 506C, so I can talk about it, but it's not fully done yet. But $4 million business producing $4 million a year. It's about 50% profit. It's an e-commerce brand selling clothing and merchandise. You can purchase it for about $4 million. You can get an SBA loan, so it's about 1.2 million basically to put down into it. And one of the partners on this is just a rock star. His business is taking e-commerce brands and scaling them up. So he's taken 5 or 10 brands, and he's taken them from 1 to 5 million in sales per year and gotten them to somewhere between 2 and 10x where they were before within a couple of years, right? So that kind of idea is really unique because it produces a lot of cash flow, has a lot of upside. You have unique players that are in that space to really scale it up. And I just see, incredible, like you're able to use leverage to get into it. And there's a lot of positive. Even if you just buy the business and you own it, you basically get the money back that you put into it, within a year, right? Which is amazing. And then you can just cash flow. So I think there are times where it's great to be a real estate investor. I think there's times where it's great to be a private equity investor. There's times where it's great to be, a debt investor. And I think there's attractive things about all those things. But Courtney, why don't you talk about, what are some favorites for you right now? What are some things that you're interested in?
Yeah, that's a great question. So I'm definitely interested in, private equity and debt funds. Obviously I'm going really heavy right now on oil and gas. And eventually I will move back into real estate. I'm just kind of sitting on the sidelines watching what's going on there and looking for those great opportunities, but definitely private equity and definitely oil and gas. I'm hitting both of those pretty hard right now. So, but okay, the cash flowing businesses. I love that you brought that up because that is, I'm on, oh, what is it? Cody Sanchez's, email list, and I get all our
Yeah.
stuff. And, I'm definitely interested in acquiring some cash flowing businesses. I haven't pulled the trigger on that yet, but it's something I've been, deep diving into. And I've seen a lot of the commerce stuff kind of trickling out and seeing some of that, trickle through the space. So I'm going to have to holler at you later and you can tell me a little bit more about what you're working on because I like that.
Yeah, our goal is to kind of do it with one or two and then be able to scale it up and do it with more companies or bigger companies as well. So we're getting kind of toward the end. I wanted to ask each of you, there's some questions coming out. Again, I just encourage you, if you guys can put your contact information there, Patrick and Courtney, in the chat. If you're watching this on replay, you can just search their names and find them online. But I want people to be able to reach out to you because people are saying, well, how do I hear about that, recessionary, fund, or how do I hear about the acquisition fund, or how do I get involved in Courtney's deals? And so if you're not on their deals, you should be. If you're not on our deals, you should be. It's just a great way to hear about unique deals. And again, lots of respect for these guys. Okay, so let's see, we got passive investing mastery. I'm going to just share a couple quick announcements, and then we'll get kind of the wrap here. There are a couple more questions here. There's some general questions. What areas of real estate are good to invest in now? Unique, interesting deals. Sorry if you guys touched on this for younger credit investors. Anyway, there's a couple more questions coming in. If anyone wants to jump in the Q&A and kind of start answering, type some of those out, you're welcome to do that. I wanted to say we are having another event that I'm super excited about. Okay, this is one of the most unique. This is almost as exciting as when I had Harry Dent and Lizette Zhang, and they almost started like hitting each other over the Zoom thing about arguing about how gold and silver versus other investments. And if you don't know Harry Dent, he's predicted like 19 of the last 2 recessions. So he's very, very doom and gloom. But this event is even more exciting than that. So this is basically which is better, gold or Bitcoin, right? So I've got Mark Moss, I've got Bridger Pennington. So if you don't know Mark Moss, super well-known guy, talks about economics and crypto and stuff. And then I've got Bridger Pennington, who manages a hedge fund with crypto, I think a $20 million hedge fund with crypto. And he also does I think fund launch. He helps people raise funds. And then I've got Dana Samuelson on the gold side. I'll probably get one other person on the metal side. And we're just going to have a full knockdown, drag out. What's better, is gold a good store of value? Is it Bitcoin? Why? People have strong opinions either way. But, anyway, so I look forward to that. That's June 11th at 4 p.m. Pacific. You can put it on your calendar. I don't have the final graphic yet, but we will soon. If you want to email me, you can feel free to shoot me an email. We are in the process of creating something. It's pretty new, and we don't even have a name for it yet. It's probably going to be limited to about 5 to 10 people, high net worth individuals. People have to apply. It's going to be a networking group primarily to have people that can bring stuff to the group, bring education and teaching to each other, as well as, I have got a house in Aspen, and then also an ask, hey, I've got this deal I'm struggling with. I'm not sure what to do in my business here, but it's primarily going to be a passive investors type mastermind group. We're going to have couple of monthly virtual meetings, and we'll have two over a 6-month period. We'll have like 2 one-day events, probably one in LA and one probably in the Midwest in Dallas or something somewhere. So I'm pretty excited about that. If you're interested in that, please reach out to me. We can put you on the interest list, but that's kind of probably only 5 to 10 people, very small, but we're pretty excited to be able to create that. I wanted to give Courtney and Patrick just one last chance to say anything you wanted to say before we wrap up, if people want to reach out. So thank you for being here, guys. But Courtney, anything you want to say as we wrap up here?
No, I appreciate you having me. This has been great. I love having these conversations. I think I'll just let everybody know, go to some conferences, find some podcasts, and find the information. There's so much education out there. Get plugged into some good groups where you can bounce some ideas off of what this group you're talking about. This is great. Those are the things where you can go in and you can talk about due diligence, and you can talk about vetting, these syndicators that are putting deals together, and really help, figure that out. Don't go at it alone. Get plugged into some groups and have those conversations. There's some really, really great people out there.
Absolutely. Thanks, Courtney. So glad you're here. I so appreciate all the value you bring every time I see you. So thank you.
You're awesome.
Patrick.
Sure. Well, I'll echo what Courtney and Bronson have said. Definitely get out there. I say do one passive step a day. Let's listen to a podcast. I run around the lake in the morning. I bet one active step a week. Go join a webinar and get in front of people once a month. Join a meetup. Just get in front of people. Get involved in a tribe. You'll get exposure. We have a series like this. Bronson has one. I'm very excited about those. If anybody's interested in getting a copy of my book, it was a bestseller. We give it out for free. I sign it and send it out. Talks about my whole journey, how I'm from high tech, lost it all, came back, did single family, multi, diversified, and ended up in Hawaii at one point. Got married on a horse in Beijing. It's a really cool story. A lot of other people, Phil Collins,
like a movie,
Leopard did a chapter. It's an actual rock star. I didn't hear what Bronson said, but I'm gonna blow right over it. So
I said it's like a movie. It's like a made for TV movie or something,
Right. Right. Well, lot of adventure. I'm an adventure sports enthusiast like Bronson, so you're gonna hear a lot of stuff about that too. Passiveinvestingmastery.com. I'll spell that, passiveinvestingmastery.com/book. And you jump in there, put in the offer code, just write down the name of this webinar, Bronson, whatever it is, and then I'll sign it. She'll ship you a copy. If it helps to inspire you along your journey, happy to do so from somebody who was, a high tech, paid well professional and made it out. Otherwise, love to talk to you. One of my whys is being able to give back to people that are working hard, not seeing the light at the end of the tunnel, or trying to hustle hard at side gigging, real estate, or whatever it is, and not quite getting out like I wasn't. Set up a call. I'm happy to chat with you, get you pointed in the right direction. And I definitely forward people to these people on this webinar and others. So if we're not a good fit for you, we'll make sure that you get in the right hands with the right kind of people.
Awesome. Yep. Awesome. Well, guys, really appreciate you. I think we're at the top of the hour. Appreciate everybody for being here. Thank you for taking the time to educate yourself. Really, it's humbling, it's encouraging, it's exciting, because that's, as Warren Buffett says, the best investment you make is in yourself, is in your own education. And so you did that here tonight. So well done. You spent time with me, with Patrick, and with Courtney. And we'll look forward to seeing everybody on June 11th for the next event, or set up a call with me, with Courtney, or with Patrick, or with all of us. Maybe not at the same time, but we're excited to get connected with you. And thanks again, everybody. And if you're watching this on the replay, feel free to reach out as well. And everybody have a wonderful night. Thanks, everybody.
Thanks, Bronson. Appreciate everybody's time.